Today I am going to discuss about monetary policy. You may recall that in the introduction of macroeconomics, I had provided a brief introduction of monetary policy that in order to attain the objectives which a nation is strive to achieve, namely increase in GDP, generation of employment, and controlling of inflation and achieving a healthy balance of payment. Monetary policy, along with fiscal policy, is, is the most important tool which every country utilizes or uses to cast an impact on the objectives. the the monetary policy is conducted by central bank of a country. In India, Reserve Bank of India. In Europe, for example, European Union, it is the European Central Bank. Or in US, it is the Federal Reserve. So the responsibility of conducting the monetary policy is entrusted with the central bank of that country. And you know that when central bank of a country like in RBI, Reserve Bank of India, is a bank, government's bank, it has got various mandates like issuing of currency notes and so on and so forth. So it is conducted by RBI. And so what I'm going to do that I will take a definition of monetary policy, and then I will go on to discuss about what are the tools uh, that can be used by RBI to conduct monetary policy, namely the discount rate, the open market operation, and cash reserve variation. So let us take the definition of monetary policy. And monetary policy involves the management of interest rates and quantity of money. It also referred as supply of money. So it simply means that monetary policy is concerned with the changes in supply of money. Supply of money can be increased or decreased. How the supply of money can be increased or decreased, just I would like to point out here briefly that you know that the any central bank conducts the policy through the banking system. And all the banks are governed by the RBI. You know, the RBI plays the regulatory, supervisory, and other roles. So whenever RBI does anything, its effect is transmitted through the banking system. So let's keep in view this thing. And so monetary policy is concerned or deals with the or uses change in supply of money. Now the question is that what is money? I'll come back to this. Money is anything which is accepted as a means of payment. That like if you want to have exchange, like imagine an economy where there was no money, so barter exchange was there. You know, for example, for example, I am a teacher and I am I'm hungry and I would like to deliver my lecture. I will search a certain student who can pay for me. Similarly, goods transaction within a goods were exchanged in place of other when there. So in past, various things have been used as money. So money is naturally is anything which is accepted. Maybe you can have an exchange. So what has happened that because of the invention of the currency notes and the currency, for example, a barter exchange to take place, there has to be a coincidence of bonds. A hungry teacher and a student who has a quest for knowledge. If they do not have this thinking coincidence, then the exchange will not take place. So coincidence of one. So because of the money, which is the what has happened, that this is not required. If you can pay, maybe in coin, currency notes, and all that. So that is why money is anything which is accepted, and it is can also as a store of value. And another store of value may be affected by rise in price also, and it can also be used as a method for deferred payment in future. One can use money, you borrow money now and pay at a later date. So all these things are. So anything money is, and somebody said about money, money is what money does. So in the past, various things have acted as money. So now what RBI does, or the central bank does, is that RBI tries to control supply of money. Now, what is supply of money? Let us try to understand it. Now, there are certain measures of supply of money. One is known as M1, and another measure is M3. Other measures are also there, but I have not taken. Now, you will agree that there is no, there cannot be debate that currency notes and coins which are in circulation, they are money. So that the amount of money with the public, in circulation is money. Naturally that can be used for exchange of goods and services. Plus, there are deposits in the bank, demand deposit, current deposit, which can be easily converted into cash. There is no restriction, unlike saving deposit and other deposit. There are no restriction. They are as good as. And there are other deposit with this commercial bank with the RBI. That is also easily convertible into cash at any time, or the provides liquidity. So they are very liquid. It can be converted into cash easily. Then there is another method which is used by RBI is M3. M3 is this currency and this plus time deposit. Time deposit are for fixed period of time, but that can also be converted into cash. Although as far as liquidity is concerned, the demand deposits can be quickly converted, but it may, one has to apply for that, and then it can. But they are also with the banks, and that can also be converted. So this is the very narrow measure, very liquid, and this is less liquid in comparison to this. So what the RBI does? The RBI tries to control these things. For example, the number currency in circulation as well as the deposits, which are with the banks. So RBI tries to control. Sometimes RBI wants to increase supply of money, and sometimes decrease supply of money. How it does, we will look at this. Now, given this thing, the objectives of the RBI wants to control supply of money. The objectives are, which I have already explained to you, that the RBI or the central bank want to bring price stability, contain prices, generate employment, and proper economic growth, bring stability in financial market, and keep a check on the fluctuation in the interest rate. There are gyrations which are there, and also intervenes in the forex market, which we'll discuss in exchange rate, in the buy and sell foreign currency. So these are. Now, whenever any policy action is taken, this policy action has to cause an effect on price, for example, containing inflation. Now, RBI takes some action, and inflation, the rise in price. When action is taken by RBI, how long it will take to have an influence on rise in price? So this is called lag. How much is the lag? The effect of policy action to play it out, how much time is. So this is called lag. Any monetary policy operates, any policy operates with a lag. Lag means that it is not like you are driving an automobile. Now you can bring the automobile back and forth, quickly. So it is like when RBI takes action, then it takes time to have an effect on the real variable like these things. So according to various estimates, it takes 6 to 9 months to have a the transmission, the effect which is caused through these variables takes time. So as you'll see in fiscal policy, the effect is not that long, because of the fact that if you increase the tax rate, effect will be immediately that from the next month the salaries will go down like that. And there are so many factors why it takes long. So that is why I do not think that when RBI does anything, announces some policy action, the immediately it will affect the prices and all that and other things. So just keep in mind. Now the question is that RBI want to increase supply of money and decrease supply of money. Now, what are the tools available with the RBI? Now, there are several tools which are available with the RBI, but just I would like to point out that as I said that the RBI, RBI operates with the banking system, So the banks are there, RBI action affect the banks and banks, that and because of this supply of money may increase or decrease. Now, the first tool which RBI can use is that, and that RBI also acts as a banker's bank, all the commercial banks and others. So whenever they are in need of liquidity, they can approach RBI and RBI can provide a loan. For instance, the rate which is RBI charges on the loans to the bank is known as discount rate. Why discount rate is used this terminology or in some cases back? This I will explain to you what does it mean, why the traditional reason for that. For instance, if RBI charges high interest rate, it signals that the borrowing will be costlier. If RBI lower the rate of charges, lower rate into commercial bank. So when RBI charges lower interest rate to the banks will also charge lower interest rate to their client, to the borrowers from the commercial bank. So why this terminology discount rate is used? But because there was a thing which we call bills of exchange. In Desi version it was hundi. Okay. That it is, for example, there are some tables, like somebody has sold a trader and the amount is due after 3 months. Okay. 1 lakh, let us say, will be due. That so below that naturally the sales are not on cash always; they're always on the credit, maybe on credit as well. So they will after 3 months. So and the trader needs cash right now, so it can take this to the bank and bank say that we'll receive 1 lakh after 3 months. So we will charge this much interest rate on this. So they will deduct the amount accordingly. Instead of paying an entire amount, which they will realize after 1 month or 3 months, they may say that we will pay you 98,000. Just an example, and the rest is 2,000 will act as an interest rate for this period. And now, in the current, the modern terminology is that the rate at which the RBI provides loan to commercial banks, and it is RBI's responsibility to inject liquidity whenever the banks are. Otherwise, if the banks require cash liquidity, and then there might be default. Banks have to make payment to them. So that is why RBI is always a lender of whenever they say that last resort, whenever other means are not available, to the commercial bank can approach and RBI can provide. And when RBI want to decrease supply of money to in the economy, RBI will charge high interest. If RBI want to increase supply, RBI will charge lower rate of interest. If RBI want to reduce supply of money, it will charge. So by charging higher or lower interest rate, commercial bank in return will also charge higher interest from their client. Then there is another method which is known as open market operation. In order to understand this thing, let me just tell you that every commercial bank in India has to keep certain percentage of their deposits in the form of cash, which is known as cash reserve ratio, CRR. That this is 3%. And they have also to keep certain percentage of their deposits by investing in government or government approved securities. It means that the securities means financial instruments. And this is 18% currently. It means that total deposit with the bank, 21% has to be kept in the form of cash and plus 18% by investing. And then the rest, that the rest will be 79%. The 79% they can lend. Okay. It means not the entire deposit with the bank one can lend, but and on this cash which is kept with the RBI, very low interest rate, and government securities return is also very low. So it means that if these are increased or decreased, for example, if CRR is increased, then more amount will have to be kept and the ability to lend will lower. Or CRR is, if it is lower, then more money will be banked. And just imagine this before in 19, even not, I'm not going back further. Till 1991, the SLR was 39%, and this CRR was more than 12%, 15%. More than half of the deposits were to meet these ratios. Slowly, the government is reducing this. Now, and one more thing, keep in mind that as these ratios, these ratios, they will go on changing, because that the deposits, if they increase, more money will have to be kept in the form of, and every fortnightly, every commercial bank has to report to RBI whether they are the keeping this. And the entire Harshad Mehta controversy, one of the loopholes in the system was exploited by Harshad Mehta. This greatest scam of Indian stock market was that the reporting period of the banks were different, and therefore that was exploited by these unscrupulous brokers to their advantage. So just keep in mind it. So what RBI? So that is why when their deposits are increasing, so they will have to keep investing in the government securities and like that. So why I am explaining this thing? The reason is that open market operation, that is the central bank, is also the government's bank. And when so what the RBI does, that RBI issues government securities. Either it will sell government securities, bonds, or it may buy government securities in a government. And why government has kept SLR? Another thing, please keep in mind that the borrowing, the deficit in budget, government has to meet from the borrowing, from the market or from the bank. So that is why in USA there is no SLR, just for your information. Okay, I will come back to this point when I discuss CRR and SLR. So what the RBI does, that if RBI wants to, and regularly the RBI issues and retires, for example, the earlier issued securities, and every security, financial bond or other, they have a maturity period that after the maturity period, RBI buys that and pays to the bank, and then a new issue.
Excuse me, sir.
Yes.
Sir, you talked about Harshit Mehta. So, sir, the scam which took place is out of the reserves which SBI provide or out of the lending amount, that 250 million?
No, no, I just hold on this. I will answer the question. I think that I should not have said this, and otherwise you go to. Okay, just keep it in abeyance for some time. I will answer the question the last. Okay, so
Okay, okay. Thank you,
just
sir.
just uh, see. So what I'm trying to point out that RBI also issues government securities, that is bonds, uh, to raise fund for the government. So that will really, and please remember that the this every commercial bank have to make investment in government to the extent of to the tune of 18% of the deposit, and this deposit, mostly they will go to incremental. They have to meet this requirement. So when RBI wants to lead to the increased supply of money, what RBI does, that RBI purchases the already issued securities. When RBI purchases these things, then RBI pays to the banks. Naturally, the amount of investment done by the commercial bank will be paid back to the bank, and that will increase the monetary base. The deposits of the commercial bank and their ability to provide money, lend will go up. Now, if RBI want to decrease supply of money, what RBI will do, that it will sell a government securities. When it is sale, it is subscribed, bought by the commercial bank. When commercial bank will pay out of their deposits, and their deposits will go down, and because of that the monetary base will go down and their ability to lend will go. So, and wherever the RBI buys or sells, although statutory requirement is this much, 18%, it is not, the banks may invest more than this. So this is the statutory requirement, the minimum. More than that, so whenever RBI gets, there is also, the guide. It signals that when RBI will buy securities, it pumps money supply, money, by paying back to the commercial bank. And when it sells, it sucks the supply of money, because that will be subscribed by, that will be bought by the commercial bank. And so this is how the open market operation, and it's a regular feature. It is a regular feature, and this has a linkage with what we know as repurchase agreement, repo rate also. So I will repeat once again. For example, let us take a simple example. For example, Reliance wants to issue some shares. The public, which will buy the share, the money of public will go to Reliance. Similarly, if the RBI sells government security, the banks will pay out of their deposit. So their deposit will decrease. And the money monetary base of all the banks. Please do not think one bank, the entire bank will decrease, and their ability to lend will go down. Similarly, when RBI buys, means retires, redeems the government securities, so naturally the amount of invested by the bank will be paid, and that will inject the money in the system, banking system, and the bank will have more money to lend it. So it's a regular feature, because the government always runs a deficit, and government tries to raise funds through this, in this way, by paying a not very attractive rate of interest on this. So this is how the open market operation plays out. And there is one more thing which is related to this, is which you often come across, is known as repo rate. I will just, and this is a temporary open market operation. What I mean by this is that, as you know from your knowledge, that every commercial bank, minimum 18% of their deposit they have to keep invest in government securities, and they have made investment in government bonds. Now, sometime it happened that the commercial bank, they are in dire need of liquidity. Okay, so what they can they can approach RBI and RBI can provide loan to them through also. But what these commercial bank, what they do that they park their some of these securities, the financial securities as a collateral, and against which they borrow. I give you a very simple example. For example, if you want to approach a bank for borrowing, you want to get a loan, bank will ask you what is the collateral. For example, if you do not pay, that can be sold off to recover the loan. So if you provide the collateral and bank, so the rate of interest charge is lower in comparison to which is very high risky, where there is not a backing that in case of default. So why these commercial bank they do that, they temporarily keep their securities, financial securities, where the government security with the RBI to lend to get the borrowing loan, and after certain period they buy back. That is why the word repo is there, repurchase agreement. Like, and it is very short duration, maximum 15 days. For example, 1 day, 2 days, 3 days, 5 maximum. Let us say after 2 days. Let us say one commercial bank requires loan, and it has these securities, so it can keep with RBI. Now, let us say the security is worth 1 crore. A very simple example. 1 crore. Now, what are they naturally all the things are that not the physical nowadays. Everything is so that they can keep it. Even in the time when it was physical, that they transfer, so they can keep temporarily with the RBI. And okay, we are keeping it 1 crore worth of security with you, and provide us the loan. So what the RBI will do that, I will provide loan against these securities worth 1 crore, and the RBI will not provide the entire amount, rather it will charge a rate of interest which will be for this period. So it will not 1 crore but be lower. So what the or another case is maybe that the 1 crore is provided, but at the end of after 2 days, the banks will buy back the securities, will pay the amount, let us say the 1 plus the rate of interest, and will buy back. So it is a temporary parking of financial securities, government approved government securities. It is a collateralized borrowing, like this. So that is why the terminology is repurchase agreement. When commercial banks borrows from RBI by doing this thing, it is known as repo rate. The repurchase agreement. And it is not a permanent. It is just a keeping as a guarantee, and that in case if they did not pay, then there might be the amount, these securities can be sold in the market and can give, because the securities are worth this much. So it is like with the word repurchase agreement. So there are two legs. On the one leg, the commercial bank says that they keep securities, and the other leg, that is after that period, they buy back by paying the amount plus the interest. Reverse repo is that when RBI, for example, commercial bank, RBI, if it is in need of cash, it can also approach the commercial bank. Normally it does not happen, but it is, that just to indicate, that what is the rate of, so the rate of interest charged by commercial bank to provide loan to the RBI is known as a reverse repo. Earlier the terminology was very confusing, but now now it has been done away, and that's clear now how this is. So this is for example, in recent credit policy announced by RBI, the repo rate and the reverse repo rate was kept unchanged. Repo rate is currently 4.4, and reverse repo is 3.35%. And if your commercial bank borrow from RBI, they will be charged 4.4 for the period. As I said, that maximum duration for this type of loan is not more than a fortnight. So this is how, and this is a borrowing against government securities. Now the other thing should be clear too. I have already explained to you that every commercial bank has to keep certain percentage of deposit in the form of cash, and this is 3% currently, as I have already explained to you, and this is 18%, and 21%. That is, they have the minimum investment, not an approved security that bank must keep against deposits. So deposits, whatever they are, so 3% and 18%, they have to keep it. And if the deposits in the CRR in SLR increases, SLR is increased, then the deposits available, the money available with the banks will go down. So, and their ability to lend, they will charge high interest rate. And if these ratios are decreased, then what happens that the more money will be available with the banks, and they can. And the total deposits in India are more than 154 lakh crore total deposits, more than. So you can understand that even 0.25% increase or decrease will, how much money will be sucked out of the entire banking system or injected. So when the deposits are to the tune of this, so it means that taken together, all the banks. So that is why even whenever there is a reduction or increase, is that it is hardly more than 0.25, and both of these are not done simultaneously. In a 0.25% will have a drastic impact taken together, all the banks. So this is how as I said, that gradually government is doing away with the ratio. SLR is now 18%. As I said that in US there is no SLR, because government, like any other firm, any other what you call it, commercial entity also borrows from the market. So CRR is there. CRR is US also there. 2% CRR is there, because that is acts as a safety net for the bank, the depositors, and also that is there. But SLR is not there. And why SLR was in India, as I said, that it was in 39-40%, and before it was more than the banks were left with hardly 25% of their deposits for lending and borrowing. Other, because to meet the government, borrowing requirement, because it is a captive market. Whenever RBI comes in the market and issues government securities, commercial banks have to subscribe this to fulfill this ratio, or sometime more than that. So, and that is why the government securities market is not developed. Most of the investors are the banks. Rate of interest is not very attractive. One more thing is there, just I will tell you in the passing this thing. That in the last part I will take up this. You see that now I have discussed with you this thing: open market operation, discount rate, and reserve ratio. Now RBI will increase supply of money or decrease supply of money depending upon the economic condition that prevails. For example, recession. Recession is a period of low demand. Unemployment is high, GDP is going down, and it is a period of prices are rising. So they may be broadly. So what the RBI will do, that RBI has to boost demand, and so that GDP and other things increases. So what RBI will do, that RBI will try to increase supply of money. And please keep in mind that it operates through the bank. So what will do, that will buy government securities. When it buys government securities, it will pump, it will pay to the bank, and the deposits will increase. Their ability to lend will increase, and will bring down the rate of interest charge. So that will make the borrowing cheaper. And reserve ratio requirement can be decreased, like CRR and other SLR can be decreased. So because not all these are taken simultaneously. Please keep in mind, if you take all these things simultaneously, this will huge impact, will be created, So, and if you, the RBI want to decrease supply of money because to contain rise in price, what RBI will do? That RBI will issue government security. The banks will subscribe out of their deposits. Their base to lend, that is the ability to lend, will decrease, and therefore the supply of money will reduce and prices may be controlled. Similarly, rate of interest may be increased. Rate of interest. And this CRR and RSLR may be also increased, not simultaneously. So even as I told you that small increase or decrease has caused a huge impact, which runs through the banking system and overall. So this is how the RBI and RBI every that comes out with the monetary policy changes every quarter, and the RBI actually conducts its monetary policy through a monetary policy committee. There is a monetary policy committee that consists of 6 members, 5 plus RBI governor, 6 members. And whatever decisions are taken, why the repo rate was left unchanged, that was the 5 in favor of no decrease and 1 favor of increase. It was 5:1. 5 in favor, 1 against. So majority decision is taken on the majority opinion. And the mandate is that they try to bring change in RBI monetary policy, keeping in with inflation target. That inflation mandate is 4 plus minus 2. It should be kept in 6 or in the band. That is why whenever the inflation increases, so they have to they take decision keeping in. One of the important thing is that the prime role of monetary policy is to contain inflation. Other thing may follow it, but throughout the world, monetary policy is used mainly to control supply of money. Because that's, imagine a situation, let me tell you, that in some cases there was a gold discovery, whenever the gold discovery, because gold was used as a money, so whenever the gold discovery was there, the supply of money increased, and because of that prices went up. Same is the case with this. Increase in supply money may lead to increase in like this. Not exactly the 1-to-1, but that if increase more money is there, prices may be. Other factors are also there, whether it will be 1-to-1 or like, because if there is too much, the decrease in demand, it may take time that prices may. But so that is why the increased supply of money, the monetary policy has an effect on the prices and all that. Now coming to your question. Your question is regarding Harshad Mehta. Just I told you in passing about that in Harshad Mehta. One of the methods, not with that the entire control, the scam revolve around this. What happened that these brokers, they are in touch with the various banks actually. When the reporting time is different, for example, if there are, let us say, A, B, C banks, D banks, okay, and they are reporting fortnightly about their requirements, CRR, SLR requirements, together they are RBI to report. And for example, at every fortnight, maybe in between there may be lower, but when they report it, they should be in line. So for example, A bank has a reporting time at, let us say, 10th of certain month. It has 15th of month, and like this. So what we'll do that this bank, for example, has 10. For example, if there is shortfall, then the B bank can be approached to lend the other bank, to make investment or selling the arrangement for to meet this requirement. So what this Harshad Mehta and other they did that they were go between they were brokers, they were trying to take this loophole, so that the banks meet the requirement. Now RBI has done away with this thing. The reporting time is So this is one of the method by which that they did it. What I told in the passing that reporting time, but they have to meet this requirement. This is what this was not the entire issue with the Harshad Mehta controversy. There was various kind of this was mainly from the stock market where there the trading and other loopholes were.
Yes, sir. Okay, sir. Got it. Thank you so much.
There are other things as well, but I will take up in next class. I think that you can keep in mind this and we will, if you have.
Okay, sir.